The market is soaring, but should you be celebrating or getting more cautious? Today, I'm breaking down why valuations are flashing warning signals and why many businesses don't meet strict investment standards, well, at least for right now. I'd like to talk about how long-term investors are able to position themselves with not emotion, but with clarity. So I'd like to start off with valuations first. Right now, I'm recording this October 28th, 2025. The average tech stock is trading at over 35 times earnings. That's an earnings yield of just 2.8%. And concurrently, the S&P 500 is sitting at an earnings yield of about 3.45%. So to give you some context, risk-free treasuries offer higher yields. So the question is, why take on equity risk?
Oh, here we go again.
Why take on equity risk if you're not being adequately compensated for it? In this kind of market, fewer and fewer businesses are starting to meet the rigorous investment criteria that we want to look at. Even recent trades are starting to show gains, especially the AI trade has been red hot the last couple of years. They aren't necessarily attractive from a long-term perspective, especially when you look at the risk-adjusted returns. And here's the data that matters. The equity risk premium, that extra return or expected return for owning a security or an investment over government bonds, is near its lowest point in over 2 decades. The market has been driven by business-to-business growth, especially in artificial intelligence and semiconductors, also known as chips. Meanwhile, consumers are facing sectors are slower. So it's been tempting to follow the excitement. But historically, when the crowd starts chasing performance, what the disciplined investor does is takes a step back and looks at the market, because the market is there to serve you, not to instruct you. We've seen this story before many times in the past. A couple of instances to remember is the dot-com bubble in the 2000s, the 2008 financial crisis, and then most recently the COVID recovery surge. Now we're seeing low earnings yields paired with higher treasury rates. And this setup historically calls for a little bit of caution, not complacency. The one reason why many institutional investors, including large companies that you may know of that Warren Buffett has been in the helm for a long time, are holding high levels of cash. And why is that? It's not because opportunities don't exist, but it's because they aren't meeting the strict risk return standards right now. So being patient, precise, and prepared isn't market timing, it's discipline. So what's the big question? What can you do? First, don't chase. You want to raise your standards and study historical context. And remember that not participating in everything is often what preserves long-term capital. So if you helped clarify your thinking, if this helped you, hit the like button, subscribes, maybe share it with your favorite friend who is a major investor or someone who just needs to hear it. And remember, this content is for informational purposes only and is not intended as investment advice. Something as a licensed financial professional, I always have to say. And if you have questions, make sure you consult a financial professional before making any investment decisions. Thank you for watching. This is 369 Financial, helping you see the market with strategic clarity.